Impact of credit on money management. So the questions to consider in this video are: what is a credit score? How does it affect interest rates? What determines credit worthiness? What are some different types of financial institutions? What are their advantages? What is the real cost of credit? Financial institutions: banks, credit unions, investment brokers, loan agencies. So these are the four types of financial institutions, and these are the services that they offer: checking accounts, debit cards, saving accounts, loans, internet banking, online bill pay. So it is necessary uh, to comparison. So for a financial institution, you need to find an institution that will provide the services and products that fit you. For example, online bill pay would be useless if you did not have access to a computer. Online banking services. So first one is direct deposit. Earnings or government payments automatically deposited into bank accounts, saving time, effort, and money. Automated payments. Utility companies, loan payments, and other businesses use an automatic payment system with bills paid through direct withdrawal from an account. So this is the second type of online banking services. Then the third one is automatic teller machines, which allows customers to obtain cash and conduct banking transactions. Some ATMs sell bus passes, postage stamps, gift certificates, and mutual funds. Fourth one is point of sale transactions, acceptance of ATM check cards at retail stores and restaurants for payment of goods and services. Stored value cards, prepaid cards for telephone service, transit fares, highway tolls, laundry service, library fees, and school lunches. So these are the smart cards that can be used in schools or in private areas. Then the next one is electronic cash. Companies are developing electronic replicas of all existing payment systems: cash, check, credit card, and coins. Cyber banking. Banking through online services. Financial institutions with website cyber branches allows customers to check balances, pay bills, transfer funds, compare savings plans, and apply for loans on the internet. Smart card. Smart cards are being sometimes called electronic wallets and look like ATM cards. However, they also include a microchip. This mini computer stores prepaid amount for buying goods and services. It can also store data about a person's account, balances, transaction records, insurance information, and medical history. So what are credit score and reports? Credit rating. Credit rating is a measure of a person's ability and willingness to make credit payments on time. So this is the credit rating of a customer. There are three C's of credit. First one is capital, character, and capacity. So capital is personal item of value. Character is the ability to be trusted. Capacity is the ability to repay a loan. Info found on credit report. So there are some information that can be found on the credit report of a customer. First one is the full name of the customer, any alias that you have ever used, that means any other name that a customer has used, social security number, current address, previous addresses, and the credit report may also contain the phone number of the customer, age and date of birth of the customer, and the employer details also. There are also some information that cannot be found on the credit report, which are race, color, gender, national origin, marital status, political persuasion, and medical bill details. So these are the some information that cannot be found on the credit report. What is a credit score? A snapshot of a person's financial standing at a particular point in time. So this is the financial situation of a person. So the banks can analyze the financial situation of a person from the credit score. The one most widely used in the FICO score. So FICO means Fair Isaac Corporation. The FICO score a three-digit number between 300 and 850. So this is the score of a person's ability to pay back any amount that he has borrowed from someone else. So what are the benefits of using credit? Convenience of purchase. Buying on credit can be more convenient than using cash. Using credit makes the initial purchase very easy. Less risk of losing cash at the time of purchase. So when using cash, you have to worry about someone. You don't have to worry about someone stealing it. One who loses a credit card has a limited or no liability for unauthorized charges if the card company is notified. So let's suppose your card is stolen, or you have misplaced your credit card. You can notify the bank, and after that point of time, if any transaction happens through that card, you don't have to pay that particular amount. Free use of another's money. So generally firms do not charge interest if the entire debt is paid by the end of the billing cycle. The buyer uses another's money for that period of time. So it is free money for a limited period of time, that is a month, around a month. Building a credit rating. So the credit card also helps someone to build their rating in the financial world. Some people use credit to develop a good credit rating. Once a good credit rating is established, they can get credit for larger purchases such as automobiles and houses, etc. So they can start from some small items, and after they have built their rating, they can purchase house also on credit. Limit freedom to use future income. Using credit will limit the amount of future income for other purchases. Using credit means you will pay for the item in the future, both the principal and the interest. Decrease cost due to sale price. Some people use credit when there is a good sale. In some instances, they pay less because the savings from the sale exceed their credit charges. Strategies for maintaining positive credit include practicing good banking techniques such as not bouncing check, paying bill on time and consistently, avoiding bankruptcy, not having a criminal record, having a low number of credit store cards, removing errors from credit report, maintaining reasonable amounts of unused credit. Relationship between a credit score and cost of credit. If the rating is high for a customer, then they will have to pay less interest on the borrowed money. So around 61% of Americans said their knowledge of credit report is fair to poor, and only 3% of Americans can name the three main credit reporting agencies. So there are two types of debt. One is good debt and bad debt. So good debt is a reasonable mortgage loan, a reasonable auto loan, student loan, business loans, and small credit load. And what is bad debt? Bad debt is excessive credit card debt, furniture loans, computer loans, retail store card debt, payday loans, tax anticipation loans. So who can look your credit score? Lenders and utility companies, cell phone companies, insurance carrier, employers, military, rental agents, and bank. So in Here you can see which accounts build credit. So if you have credit card, it will build a good score of yourself. And store cards also, auto loans, mortgage, personal loans, furniture loans, computer loans. What doesn't build credit is checking account, cell phone, utilities, insurance, rental agent, employers, payday loans, and title loan companies. So how does the credit score affect the financial options of a customer? If the score is high, then they have to pay low interest rate on loans, and they will have the ability to receive loans and credit on time. Reflect borrower is a low risk to lender. Ability to acquire convenience such as cell phones and credit card. And if the customer has a low credit score, that means they have to pay high interest on the loans, and they have inability to receive loans. Reflect borrower is high risk for lenders. Inability to acquire convenience. How does a credit score help me? So it improves risk assessment, lenders, insurance, employers, and housing. It will give more equal treatment among borrowers, able to qualify more quickly for credit, and the lenders can rely on the credit score to give credit to a customer. Credit mistakes will not affect your ability to obtain lending as drastically. So in this chart you can see the longer the term, the more interest, the more you have to pay in interest. So if you are taking a loan for 1 year, then you have to pay less interest, and if you are taking a loan for, like, let's say 10 years, 11 years, then you have to pay 10 times more interest rate. So if you never had a credit card or credit score, how can you build your credit? So first thing is open a line of credit, that is credit card. Buy things you would normally buy, pay off at the end of each month. You can purchase small grocery items, or some small purchases, and you can pay at the end of the month. That will build your score. If you don't qualify, consider a secured card. You can also deposit some money in the bank. The bank will give credit card against that amount. Then you can use that card to build your score. Take caution when asking for a co-signer. Buy things you would normally buy during the month. That means you just have to use your card instead of cash for your daily purchases. Pay the account off in full at the end of the month. That will also help you build your good score. That's all. That is all in the impact of credit on money management video.